Welcome, everybody. Today, we're going to cover an investing trick used by hedge funds to make money and reduce risk. My name is Jacob Braun, and I'm the founder of Braun Capital and a writer for Seeking Alpha. I host this weekly Monday night episode, so please come back, check it out. If you want to stay up to date on what I do, check out my Twitter at RealJacobBraun. So today, we're going to talk about a trick to reduce risk and make money. And I think those are basically the two goals as an investor we should look at. Number one, we want to make money for obvious reasons to make money. But number two, we want to reduce risk. The less risk we have while we make money is the better chance we have at keeping money. So investing is about more than just making money. It's also about not losing money, because it's very easy to lose money when you invest. And so what we're going to do, I'm going to teach you a trick that hedge funds use through stock derivatives. And the most common stock derivative that you've probably heard of is an option. And we're going to go over a specific option, the call option. The trick we're going to use is called covered calls. So what a call option is, it's the right to buy 100 shares of a stock at a certain price. So for example, company A is the right to buy at a certain date. So the right to buy 100 shares of a stock at a certain date for a certain price. So let's say we buy a call option that expires January of 2023 at $100 strike for company A. That means until January 2023, we have the right to buy company A at a price of $100 per share. And it comes in a lot of 100, so 100 shares of it. And how this can help you is we can use a strategy called covered calls. So if every single set of 100 shares we can sell the right to buy that. And by selling this right, we're making money. And we make money and what's called the premium, so the time premium. So the further out you sell it, the more likely it is to make the money on it. As when I implement this strategy, I like to do about a 20% alpha level, so an increase in share price of 20% from the current price. So that means I collect money, and if the stock increases in price by 20%, then the stock will sell and I'll make a 20% profit, which is a profit any investor has to be very happy about. And I get to keep that money I made. If the stock trades sideways or goes down in value, then it's fine. I get to keep that money I made regardless. And I get to keep my stock. So covered calls are a great strategy because they reduce your initial cost basis. And anytime you can do that, whether that's through taking profits and pulling money out or through covered calls, what you're doing is you're taking out money and reducing your risk. I like to think of this as the analogy. So let's say I put $10,000 into an investment and this investment doubles. And I pulled 10,000 out. Then I pulled out my initial cost. So what am I doing? I'm playing with what I like to say is house money. So I'm playing with money that I never put in. So I feel much more comfortable really riding the stock to whatever price it eventually goes to. So we can do a similar strategy with this with covered calls and continue to sell covered calls and in a sense just pull bits and bits and bits of the initial capital out. So we're pulling investment money out and putting it into safer investments. And what this allows us to do is it allows us to play with more and more house money, which is what at the end of the day we should all be trying to see or seeking to do as an investment. I'm going to share my screen and we're going to look at stockcard.io at a company I really like and a company I implemented this strategy on. So stockcard.io is a great tool that uses AI to help you find out about different companies. If you like the from what you see and you get a subscription, use the code best of us at checkout just to let them know we sent you. So this is the tool. I'm going to use Cassava Sciences. You guys have heard me talk about it. I've done two or three videos on this channel about it. I've written multiple Seeking Alpha articles on it. My firm, Braun Capital's covered it. We really like Cassava Sciences. And I think it's a great company, but by any standard of risk, it's a very risky company. And so what can we do to reduce that risk? Well, my strategy would be to write covered calls, because what covered calls are going to do, because this is a very volatile investment, is we're going to basically make money off of that volatility. And from when we make that off, I'm going to move that money into a much safer investment. So whether that's an index such as S&P 500, or that's another bigger name blue chip stock, I'm going to move money from my risky investment to my safer investment. If we look at the chart here, so we can see, there's high growth potential and struggling operations. So what that means is, this company has been going up and down. And the investors right now are very pessimistic. It's right now at 52-week lows as I do this video. I'm not doing this video to tell you to do it on Cassava Sciences. I'm doing this video to tell you just the strategy itself. So this is an educational video. But if we look at the chart here on stockcard.io, we see it's a very sharp downward trend. And on the 1-year chart, there's been some highs and lows. We see peaks and ups and downs, right? But anytime an investment trades sideways to down, you make money and keep shares when you do this covered call strategy. And when we do this strategy with a 20% alpha level, that means a 20% appreciation in the shares. We make money and with the premium that we collect, and keep our shares as long as it stays under 20% over our time period. So I'm going to use just a quick illustration here. So this is basically what it is. If as the stock price goes up, if we sell the stock price down here, we get to keep this money. And eventually we hit a break-even point where the stock price plus so when let's say we have to sell at 40 and we made $300 on our options, so that's $3 per share. At $43, we broke even between what we made off our premium and what we made off selling our options, and anything above that is missed out on profit. So that is one downside of this strategy. But anything below 43, we made extra money. And if we stay below 40, then what happens is not only do we keep the money we made from the premium, we also keep the shares. And that's a very big benefit. I really like doing this strategy about 1 month out, and every single month continually doing this. I do this across my whole portfolio, and every single company I can that has any real volatility in it. And what I do is I take the money from that I gain and either invest it back into more underlying shares, or I move it to safer investments. So another thing that I want to talk about with this strategy is what happens in the end of the strategy. So once the time comes when you did this strategy, and now the time comes at the end of the month and you have to sell your shares because you gave people the right to buy the shares. Well, what can we do to get out of that? Well, what you can do is you can do a strategy called rolling your option. So what you do is you push the time back to another, for example, another month, and you can increase the price, and you just play the whole game over again. And you can just continually do this on and on and on, collecting these premiums and making money off your underlying shares. This is a great strategy to make money off any volatile investment, and it reduces your risk because what you're doing is you're slowly pulling money out of this risky investment. So if you're going to be into very risky investments, I highly recommend using covered calls on this investment or any other investment, because it's a great strategy to make money and reduce your risk. And at the end of the day, what are we trying to do as investors? We're trying to do those two exact things. So again, I'm going to continually try to bring you some throughout my video series, some strategies that are heavily used by hedge funds. And this is one of them. It's a strategy to, in a sense, hedge yourself. If you enjoyed this video and you want to see more videos like it, just comment, reach out to me, things you want to see. My Twitter is @RealJacobBraun again. And check out stockcard.io if that's something that interests you. Other than that, thank you and have a good day.